What's up guys, it's James Allen, the Out-of-State Investor, and right now everyone's talking about four things between inflation, the housing market, and the current downturn of the stock market and cryptocurrency market. But out of those four things, the housing market is the only one that's actually doing well right now. You see, inflation is currently at 7% in the last year, which is the highest it's been since 1982. Bitcoin is down over 40% from its all-time high back in November. The stock market just saw its biggest drop since 2020, back when the pandemic started, yet house prices are just continuing to go up. Well, today I'm going to be explaining why these house prices continue to go higher and higher, and also why I do not believe we are currently in a housing bubble. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Right now, with house prices hitting all-time highs, with mortgage rates shooting back up again, and inflation levels hitting the highest levels in almost 40 years, it has so many people wondering, how long can this housing market continue its bull run? Well, some people believe that we may currently be in a housing bubble. But what really is a housing bubble? Well, a housing bubble is when the growth of house prices is stimulated or sustained artificially. You see, many people presume that because house prices go up for a long period of time, that it's just a matter of time before they come back down again. Now, while there may be some truth to that statement, the reality is there needs to be a catalyst to trigger prices to fall down. There isn't just some timer that goes off after 10 years and then boom, house prices collapse. A perfect example of house prices artificially going up was the 2008 housing crash we saw. Because before the housing crash took place, subprime lending was happening, and that artificially stimulated the housing market to where the housing market just imploded and house prices started collapsing. Essentially, lenders were giving home loans and other types of loans to anybody who wanted them, whether or not they could afford them. Now, particularly with mortgages, Fannie Mae was offering unconventional types of loans to high-risk borrowers, which increased the likelihood that they were going to default on the mortgage. Now, it sounds like a bad idea, which obviously we know now that it was, but the way they justified it is home prices continued to go up, especially as buyer demand increased with these loans being available to them. So because of home prices going up so fast, the home equity was able to offset the bad debt that these borrowers were taking on. So in a worst case scenario where the homeowner defaulted on the loan, the bank could just foreclose on that house, and with the equity that was built up, that would be enough to cover the losses of the mortgage. Now, eventually it did catch up with them because home prices continued to get more and more unaffordable, and while that took place, the banks continued to lend out money to people regardless of whether or not they could actually afford it. So more and more people started to default on their mortgages, and because of that, the market got flooded with many foreclosure listings. Now, I talk about it all the time, how the housing market is strongly dictated by supply and demand. Well, at the height of the crisis, the housing inventory rose to almost 12 months of inventory. To put it in perspective, a balanced housing market sits between 4 to 6 months of inventory. So ultimately, the root catalyst for this 2008 housing crash was bad lending practices. Well, those bad lending practices are no longer taking place, and so because of that, here are 4 reasons why I don't believe that we are currently in a housing bubble. The first reason is affordability. Now, the National Association of Realtors publishes a monthly housing affordability index to indicate how affordable housing is. This is used to determine if a typical family earns enough income to qualify for a mortgage on a typical home. Now, the way they actually determine this number is they measure current housing prices and measure it against the latest income data. Now, the higher the number on the housing affordability index, the more affordable it is. And right now, as you can see, housing is still very affordable compared to years past. So you can see that in 2013, that was the most affordable housing has been in recent times, when we were just over the 200 mark. Well, today, according to the latest data we have, our current housing affordability index is sitting at 147.8. Now, you can see it's definitely become more unaffordable since January of 2021, and a large part of that has been mortgage interest rates going up. You see, in January of 2021, mortgage rates hit their all-time low. Now, even though wages have seen significant increase, the mortgage rates have had more of an impact on housing, which is why housing is more unaffordable today than it was back then. So what is an unhealthy healthy level of housing affordability to be at? Well, if we take a look at the Housing Affordability Index, you'll see that right before and at the start of the housing crash of 2007 to 2008, we were mostly around the 100 level to maybe the 115, 120 mark. Well, we're still a ways away from those kind of housing affordability levels, so that suggests that we still have room for home prices to go up. The second reason we're currently not in a housing bubble is we're currently experiencing a strong job market. You see, when income growth slows down and unemployment goes up, it has a cooling-like effect on the housing market, applying downward pressure on house prices because the average home buyer isn't able to afford as much house. This is exactly what we saw in the 2008 recession when unemployment went as high as 10% in 2009. Well, today we're seeing the complete opposite. You see, right now wages are growing at a very fast pace. According to the US Labor Department, average wages have gone up to $31 an hour, which is a 4.7% increase in just the last year alone. In addition to that, you have unemployment, which has finally reached pre-pandemic levels, sitting at an unemployment rate currently of 3.9%. This is the lowest rate we've seen since February of 2020 and is much lower than the pandemic high we were back in April of 2020 when we hit as high as 14.7%. The fact is, we have a very competitive job market right now where employees are in big demand and they finally have the upper hand for the first time in a long time. This is continuing to cause wages to go up, and because of that, it's a catalyst for house prices to continue climbing. The third reason why we are not in a housing bubble right now is foreclosures and delinquencies are still low. Foreclosures played a huge role in the 2008 housing crash, and as of the latest data, only 0.24% of all loans are currently in active foreclosure, which is an all-time low. In addition to that, delinquencies on mortgages are also continuing to go down. As of the latest reports we have, they're down almost 6% in the last month and over 44% in the last year. This is a good sign that the stricter lending standards we have today has been working because most borrowers have been able to make their mortgage payments. Now, there is still 500,000 mortgages that are labeled seriously delinquent, which is twice the pre-pandemic levels. But it's important to note that the overwhelming majority of these people will be able to avoid foreclosure and sell their house without being at a loss because of the equity growth that's taken place over the last couple of years with house prices going up so much. And even for those who have been struggling through the pandemic, many banks have been working on loan remodifications for those who aren't able to catch up on their payments. Now, for comparison's sake, back in 2008, over 1.8% of home loans were receiving foreclosure filings, and in 2009, over 2.2% were receiving foreclosure filings. So that's over 9 times what we're seeing today. So overall, as far as delinquencies and foreclosures go, we are not at dangerous levels, and we continue to make progress on a month-by-month basis as we've seen over the past several months and even over the last year. The fourth reason we are not in a housing bubble right now is we have a low inventory. Now, like I mentioned before, the 2008 crisis was largely brought on by a hyper supply of foreclosures coming onto the market, and eventually the market ended up with over 11 months of supply, close to 12 months of inventory. Well, right now, according to the National Association of Realtors, as of December, we are currently at an all-time record low of 1.9 months of inventory. This is the lowest amount of inventory recorded to date, according to the National Association of Realtors, which they've been tracking this metric since 1999. Now, housing inventory has been an ongoing problem in America for a while now, and recently it's gotten even worse because of a few things. For one, we have supply chain issues, and this has been dramatically affecting the speed at which we can build new construction houses. We're having issues with getting lumber right now, and we get a large portion of our softwood lumber from Canada, and unfortunately, due to storms taking place over there that destroyed the paths we use for the supply chain, it's causing significant delays in getting the lumber. We're seeing similar delays with windows and appliances and many other components of the house, to where it's taking, instead of 7 months to build a new house, anywhere from 10 to 11 months to build a house. Now, the problem is these supply issues have been an ongoing problem for over the last decade. If I take you back to January of 2012 all the way to June of 2021, there were over 12.3 million households formed in America. At the same time, there were only 7 million single-family houses built. So by throwing these supply chain issues on top of everything else we're dealing with, it's only making the situation even worse than it already was, and that's why we're experiencing this all-time low supply of housing. In addition to that, you have millennials who are reaching their home peak buying years. You have baby boomers who don't want to move from where they're at because if they sell their house, they feel they don't have anywhere to move to with the short amount of housing supply. So with supply and demand playing the biggest role as far as whether or not house prices go up or they go down, it's really hard to see how house prices could crash or even go down at all if we are sitting at a record record low, the all-time low as far as housing inventory is concerned. So for this reason and for all the other reasons I mentioned before, this is why I believe we are not currently in a housing bubble. I don't see signs of that at this point, and because of that, I also expect the house prices will continue to go up in 2022. So with that said, I hope you guys enjoyed today's video, and if you feel like you gained any value, do me a favor and smash that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below, do you think we're in a housing bubble? Finally, follow me on TikTok and Instagram at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.